There's some other things going on out there. Well, one of the things that told us also that we're going to have this move to a new reality was the spread relationship between silver and gold. In other words, when you divide an ounce of silver into an ounce of gold, express that as a percent. And back in 2024, 25, silver, I think even, yeah, early last year, silver got down to 1% of the price of an ounce of gold. Well, think about that. Okay. What does that mean? Well, if you go back and look at that 50-year range in price, where silver went up to 50 and 50, the two prior times that it went up to 50, here's where that spread was 6.5% ounce of silver versus gold. And in 2011 was 3.1%. We got down to one. I mean, it's like silver's free relative to the mama metal. Well, our argument is not only is silver likely to go to a new price reality, but it's likely to retest or challenge or even take out the old relative performance reality it proved to have in 1980 at 6.5% of gold, and in 2011 at 3.1. Right now, we're about halfway there, 1.6 area percent of gold. Still dirt cheap on silver, but technically that spread is broken out. Now, when you can plot that spread chart month to month, you get a technical picture. And we got a basing action spanning like almost a decade. We broke through that in November. That started the clock. By the way, in November, silver was $56. So it had just broken out of the range, of the price range. And at that point, the silver spread just broke out of a basing action. And we find that whenever that spread breaks out, like it did in 79, just prior to the explosion to 1980, and it did in 2010, prior to the explosion in 2011, that spread told you something is engaged other than just the price chart. And sure enough, we went from $56 at November close to an intraday high of 122 in 2 months. 2 months, okay? And you get a pullback now, we're 84, okay? But you're still well above that $56 breakout level on the spread of November. Also, we find that when that spread breaks out, it tends to gush, not just the spread itself, the performance of silver, but the net price of silver tends to gush for a couple quarters. We're only in month 3 post the breakout, just starting month 3. We suspect this surge is likely to continue for a couple more, handful of more months, 3, maybe 4, to keep the norm of what it does in the past. And so there's a lot of factors in play here that tell us silver's in a gush. Ignore the recent break, because in each of those prior surges that we had, 1980 and 2011, there was a point in the middle of that time frame, that like couple quarter surge, where you had a bad month. And it looked like, oh gosh, that was it. And it wasn't.
Michael Oliver sees silver entering a new price reality. The silver-gold spread just broke out of a decade-wide base. Miners are surging, and the bond market is cracking. He believes a dramatic, sudden move to $300 to $500 silver is coming, and most of it happens in the next couple of months.
Well, there's also the monetary factor. If you're just dumb and you say, well, what's the monetary degradation? You go look at an M2 chart, and you go back to 1980, how much money was in circulation, M2 monetary, measure. And in 2011, and compare that to where monetary growth is now compared to those time periods. How much is the money supply doubled, tripled, And if silver were to simply match the growth of the decay in the value of the money, or the increase in supply of the money, it'd be $300 to $500 just to match that. So that's another factor that you got to look at. That's it's a glacial factor. It's not a timing factor. But it's just a fact of reality that silver is vastly underappreciated, undervalued relative to what it's selling for. Whereas gold has continued to go higher. Each of its bull moves are 8-fold dimension moves from bear low to bull high, bear low to bull high, new highs each time, 8-fold. Well, if we have an 8-fold move in gold, we started from 1,050 in 2015, would be $8,400 gold. Okay. And by the way, we've been saying that for like a year, that's not our target. That's just noting a past reality. You have another eightfold move, big deal. You had two of them, have a third one. Okay. JP Morgan, and I think Morgan Stanley both come out with reports suggesting something along that line based on fundamental factors. So we find that interesting. Maybe they're reading our reports. I don't know. So, anyway, so if gold went to 8,000, think about that. And silver said, well, I'm going to go back to my spread relationship high that I had in, let's say, just 2011. That was 3.1%. Well, what's 3% of 8,000? Like $240. Yeah. And if I'm 6%, 6+%, like it was in 1980, in fact, for a period of time there, it wasn't just that spike. You were well above 6% for like a whole year or so. Good grief. That's assuming gold only matches its prior bull market dimensions. The 1980 peak and the 2011 peak were both eightfold gains. I don't think it's going to stop there because the factors we also talked about earlier, the financial sector and stuff like that stuff hasn't even started to unfold in a way that people get aware of, and the Fed is fully aware of, and therefore the monetary panic that you could expect from them, they haven't even unleashed it yet. And you can bet by mid-May, if not before, the Fed's going to start cutting. Most of the move to a new reality in silver is going to occur in the next handful of months by summer. Okay. Now, there may be some after that, but the main goal is to get to the new reality. What do I mean by that? If you get a chart of copper, in fact, you can go to the Federal Reserve of St. Louis and type in copper, and they'll give you a chart going back to the 1980s or something. Look at that. You'll see that for decades, copper lived in a range from half a buck to $1.50 a pound. Decades of this up and down. That was its reality. Okay. And in 2005, late that year, copper broke out of that range on its own. It didn't have help from gold or silver or even other base metals. And it went up quadrupled in a matter of several quarters. Went up to 450. Okay. Boom. A new reality. And yeah, there were sharp sell-offs after that rally high, but the reality that then occurred over the next decades, the next 20 years, was basically either side of $4 as opposed to either side of $1. Okay. So copper moved to a new reality, and it did it quickly, which when it broke out of that price range, the $1.50 to 50 cent in late 2005, it didn't go to the new reality over 3 years. It went to the new reality in the next couple of quarters. A very similar divergence occurred back in 2007 as the market was top. In 2007, we had a laborious price top in the S&P, and it made a high in the spring, like in May, dropped into the summer. So did the financial sector. And then the S&P turned around again, went back up near its highs, and then in September 2007, Federal Reserve had a surprise rate cut of 0.5 point. Oh boy, party on, okay? So the S&P moved to a new high in October, so literally a few weeks after that rate cut. That was it. That was okay. But they had a party. They went up and took out the old high, which happened to also be the same high as occurred in 2000. So the high in 2007 and the high in 2000 were around 1550 of the S&P. When they cut the rates, it blasted up into the 1576, I think was the high. So it took out all the highs on a happy surprise federal rate cut. Oh boy, they're on our side. If you sold that, you sold the top tick. But during that time, the financials had already slipped while the S&P had just congested. And then the S&P made a new high, and the financials went up and made a anemic secondary high. Didn't get back to their highs. But they'd already broken, by our metrics, the financials had already broken their major momentum trend, which the S&P had not done at that point. So in other words, you had an early warning from the financials that wasn't like a table pounder, wasn't headlines, although later it would be, as we all know. But it warned you. And we're getting the same kind of behavior right now out of financials and a couple banks even that are breaking what we consider to be major momentum support levels. Now, it's not the kind of thing that looks like, oh, you're going to crash because of it. It looks like the kind of thing that means, hey, I just snapped your leg in half. Okay. And now you're crippled. And, once you get a few more entities that start to break, like Visa and MasterCard, as far as we're concerned, have broken major long term momentum trends. Well, heck, everybody's looking at AI and look at it. NVIDIA stuck in the middle of this like 6-month range, just blip, 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 nothing, no fear or alarm there. Whereas the financials are breaking stuff. And yet nobody's noticing because there's no headlines yet. But I can bet, you'd bet that the Fed knows what's going on in the financial sector in terms of credit problems. Let's do some math. Let's say gold only goes to the 8,000 level and matches the prior 2 bull market peaks. They were eightfold. Okay. If you take XAU and put it up to about 17.5% of that price, it's like a doubling plus of the current value of XAU index. In other words, they will scream in price relative to gold. Now, if you'll notice on a price chart, and we don't have it here right now, but anybody can punch up on their screen, punch up a gold chart, continuation futures, or punch up a silver chart, and then punch up a GDX chart, the gold miners ETF, and a SIL chart, silver miner ETF. They went back to their highs of January. In fact, GDX made a marginally higher high. Gold didn't. Silver didn't. What is that telling you? Even on a price basis, the January sell-off that collapsed the price of gold, silver, and the miners erased it fully, went back to their old highs. You don't do that at the top, by the way. Gold never tops, and that sector doesn't top with double tops, okay? Any significant top. It's always a spike. It was true at the bottom in 2015. It was a spike low. 2011 high, spike high. 1980 high, spike high. You don't come back and kiss the high again. The miners have already done that. So even on a price chart, you can see that, hey, they came up out of the hole better than gold and silver did. And that's an expression of what that spread says. So right now, if I were to say, hey, I'm going to invest in the gold sector, what do I want to buy? Well, you want to emphasize silver because it's going to outperform gold. And 2, you want to own the miners more so than gold. And then when we go down within the miners and divide it between the gold miners and the silver miners, we also have a spread breakout. We don't show it here, where SIL is broken out versus GDX on a performance basis. So not only are the miners saying, buy me, not gold, within the miners, SIL is saying, buy me, not GDX, okay? Because I'm likely to outperform it. So anyway, we think it's a very compressed situation that is only just now, last month's close, registered its buy signal. So it's not old, it's fresh. I think a lot of the stuff that we've been talking about is going to happen this year. And I think, especially in the monetary metals, I think it's going to happen by summer. There was a lot of the move. I think it will be dramatic. I don't think you can have an arm wrestling rally all the way up to a couple $100 in silver, okay, or beyond. I think it's going to be more sudden. And if I were to throw out a number right now, and this is not momentum based, simply price, gold made 2 high closes, one on Monday and one back in January. And they were about 10, 20 bucks apart, 5,300 plus, 5,300 plus, using the Feb contract back in January. Now we rotated to April contract. Okay. But it's made 2 high closes. If you just look at that, you ever go back through that, you're going to zoom. The top pickers will say, oh, golly, we're wrong again. And once you do that, then gold will be saying, hey, it was a joke. Okay, we fooled you. And silver likewise. And expect silver to outperform gold. So anyway, that's I think a lot of it's going to occur quickly. And certainly by the end of this year, you're going to look back and say, golly, what a year that was.